Hi, this is Mike Lembeck with Remax Commercial bringing you today's Let's Talk About It. Today's article, what we're going to be reviewing is something broke, but the Fed is still expected to go through with rate hikes. So this is going to be discussing what's going on with the banking crisis and how it's relating to the interest rate increases for the Fed meeting next week. First off, in the article, it says markets still expect the Fed to keep up with inflation fighting efforts despite high profile bank failures that have rattled the financial system. Traders on Monday assigned an 85% probability of a 0.25% point increase rate increase when the Federal Open Market Committee meets March 21st through 22nd. Goldman Sachs was virtually alone when it said it expects the central bank to pass up the chance to hike rates next week. So we're anticipating a quarter point increase, and Goldman Sachs is anticipating that they will pause. But as we go further along in the article, you'll see that that's not necessarily what everybody else anticipates. When the Federal Reserve starts to raise interest rates, it generally keeps doing so until something breaks, or so goes the collective Wall Street wisdom. So, with the second and third largest bank failures ever in the books happening just over the past few days, and worries of more to come, that would seem to qualify as significant breakage and reason for the central bank to back off. Not so fast. So, again, we're looking potentially that the Federal Reserve will increase rates. Depends too on how many more bank failures we see here in the upcoming next few days before their meeting next week. So some further problems could result in potentially them pausing those rate hikes to let the banking crisis work its way through and then kind of go from there. Further along in the article, there is a video here that I think you'll find interesting about the credit shock shows the Fed's monetary policy is biting. I think with inflation rates, that there wasn't the significant inflation rate decrease that we anticipated. So I think you're going to see potentially that this what's being discussed in this video doesn't really apply, but it's another person's opinion. So have a listen.
The last couple of days have been really tough for the markets, but I think this credit shock that's reverberating from the Silicon Valley bank failure is the first signs that the Fed's monetary policy is finally biting. I mean, and I think, one of the takeaways we have when we look at what Fed fund futures have done, which is now priced in cuts by year end, and the drop in yields, is that there are some deflationary forces being unleashed because of both the shock to the startup community and the regional banks having some tightening of lending standards that's surely to follow. And I think it does mean disinflation maybe finally have happened. We may have sort of broken the back of inflation.
All right. Pondering a pivot, Goldman Sachs on Monday said it does not expect the Fed to hike rates at all this month, though there were few, if any, other Wall Street forecasters who shared that view. Both Bank of America and Citigroup said that they expect the Fed to make a quarter point move, likely followed by a few more. Moreover, even though Goldman said it figures that the Fed will skip a hike in March, it's still looking for quarter point increases in May, June, and July. We think Fed officials are likely to prioritize financial stability for now, viewing it as an immediate problem and high inflation as a medium-term problem. So they're looking at the Goldman Sachs as a completely different viewpoint of everyone else. They're looking at it as a short-term problem with these banks, and that the overall issue of inflation is really the key factor. And that's kind of, I'm feeling that I don't see them have a Fed making a pause in their interest rate increases unless between now and the time that the meeting is next week that we see significant more problems in the banking sector. So that remains to be seen. We've got a few days left this week and then some more time before their meeting next week. So if things happen that this escalates, I see that as a reason that the Fed would pause interest rate increases to let the banking crisis work its way through. All right, next week's meeting is a big one in that the FOMC might, or not only will make a decision on rates, but it will also update its projections for the future, including its outlook for GDP, unemployment, and inflation. Undoubtedly, they're discussing it. The question is, will they be worried perhaps that that nurtures fear? They should telegraph before the meeting to the market that they're going to pause or that they're going to continue fighting inflation. That is all up for discussion. So they're going to be looking at their outlook for the GDP, unemployment, and inflation to determine whether or not, and this banking crisis, of course, to determine whether or not how they're going to steer their policy in the future. Okay, managing the message, Citigroup economist Andrew Hollenhurst said pausing, a term Fed officials generally dislike, now would send the wrong message to the market. The Fed has sought to burnish its credentials as an inflation fighter after it spent months disavowing rising prices as nothing more than transitory effect from the early days of the COVID pandemic. Powell repeatedly has said the Fed will stay its course until it makes significant progress in getting inflation down to its 2% target. So, not seeing any pause in the interest rate increases until we're at this 2% Fed target rate. Again, the banking crisis was, when he said that, the banking crisis was not even seen as something that was going to be happening until last week. And now all of a sudden, it's really apparent that there could be a further problem and further exaggeration of this whole issue and how it's going to affect our economy and how it's going to affect inflation and everything else. Fed officials are unlikely to pivot at next week's meeting by pausing rate hikes, in our view, Hollenhurst said in a client note. Doing so would invite markets and the public to assume that the Fed's inflation fighting resolve is only in place up to the point where there is any bumpiness in financial markets or the real economy. Again, more information showing that potentially they may change their policy with the current bumpiness in the economy and which is being brought on by the financial crisis with the banks. Bank of America said it remains watchful for any signs that the current banking crisis is spreading, a condition that could change the forecast. If the Fed is successful at corralling the recent market volatility and ring-fencing the traditional banking sector, then it should be able to continue its gradual pace of rate hikes until monetary policy is sufficiently restrictive. Our outlook for monetary policy is always data dependent. At present, it is also dependent on stresses in the financial markets. Again, they're looking at the same thing that the Fed is looking at, what's going on in the financial markets with the stock market, with inflation. Inflation was very little change in the recent inflation factors, so that doesn't it doesn't show that the Fed is going to stop their fighting inflation with stopping or pausing their interest rate increases. I think we're definitely looking at least a 0.25% interest rate increase, and then potentially more, unless again some of the other financial factors out there influence that and make them change their policy. So let me know what your thoughts are. Be sure to make some comments below, and then look forward to seeing you on the next upcoming videos. Make sure you like and subscribe to the channel so you don't miss any. So I hope you find this information useful. We'll see you on the next one.